Right traders, welcome back. So in this video, we're going to be going over an S&P 500 case study, right? So Price Action Labs here. My name is Sandeep, right? So let's kind of break this down, and we're going to be focusing on what I call the triple X model. And so the triple X model uses three things to become profitable, right? So I've now been trading coming up to a decade, and I went from trading 18 different strategies in under 2 years to simply bringing my entry model down to three basic things, right? It's where to trade, where to look for a trade, what to look for, and why you are looking for it. So if you take a loss, or if you take losses and you blame your psychology, I often say to all traders, in my opinion anyway, trading psychology is overrated. In trading, psychology is completely overrated. Now, so think of it this way. What is more important in the markets? You having an edge, or your psychology being, I guess, good, right? So for me, in my opinion, trading psychology is completely overrated. And the reason why is because every psychological error or every psychological flaw that you have can be fixed with a piece of technical knowledge. So everything comes down to the triple X model, right? So you need to know where to trade from, what to look for, and why you are looking for it, right? The three W's I packaged into the triple, I guess, X model, right? Triple X model. So if you're a trader who struggles with FOMO or over trading, over risking, over leveraging, over anything, right? Over trading, let's say. If you knew where to trade from, i.e., if you had a key level or two key levels, if price breaks above here, I'm buying. If price breaks below here, I'm selling. If you had one key level in the market, you could trade, right? You could avoid taking unnecessary losses or just taking unnecessary break evens, right? If you knew where to trade from, you could eliminate 99% of your over trading issues. Now you need to understand what to look for. So the what is very interesting. So you need to understand essentially that markets work on an auction, right? So indicators are lagging and patterns themselves are artificial. What you want to focus on is understanding what to look for. And so the power of this comes down to what I call two numbers, right? So if you can read two numbers and also read two colors, you can trade, right? So what you're looking for is the interaction between buyers and sellers at key levels. And why are you looking for a buy or a sell, right? So the market can do one of two things, right? You can either buy and make money or sell and make money, or I guess buy and lose money and sell and lose money, right? But why the markets move up and down every single day is for the same exact reason. So if we just take a look at step one, so number one is key levels. So we're going to be focusing on key levels, and we're going to be understanding exactly why the markets moved up and down the way they did, right? So we're going to be focusing on Tuesday of last week. So this is time of recording 18th of August. And we're going to be understanding how the market moves at key levels. And so why key levels are so important and how you can improve your psychology is by simply understanding that the market will gravitate towards certain key levels and you want to trade only at those key levels. So if you were a trader like me many years ago, I used to suffer from hesitation and over trading. So what would happen to me is I would FOMO into positions and overtrade, and then when the actual A plus setup comes, I would miss it due to hesitation. So it was a constant cycle of FOMO and then hesitation. So overtrading and then hesitation, and then overtrading and as a hesitation. So the way I fixed this problem was by identifying key levels to trade from. That's step number one in the where, what, why sequence, right? That's step number one in the triple X model. So psychology can be fixed if you understand where to trade from. Okay, that's the first thing. So what makes a key level? So the short answer is order flow is what makes you want to buy or sell at a key level. But the long answer is understanding the interaction between buyers and sellers. And to understand this, we will focus on passive market participants, right? Passive market participants, right? So what are passive market participants? So we can see here we have our two key levels. So we have a bearish key level or a supply zone or a resistance area, whatever you want to call it, right? We're not going to be referring it, I prefer calling it either a supply area as the correct terminology or a resistance area. I don't like using the word resistance because I think it's heavily over commercialized in the trading industry. It's not a breaker. It's not necessarily a fair value gap, although it kind of is. It's not so much a 2022 model or an OTE or anything like this. It is essentially a resistance or a supply area in the market, right? I like to call it a supply. There's more supply than demand, the price will move down. If there's more demand than supply, the price will move up. Now, it's your job to take that basic economic understanding and apply it to the charts. Now, why traders miss out or why they blame their psychology for a lot of problems is that they think that they need to rely on a pattern or an indicator to give them areas of supply or areas of demand, when in reality you need price action to do that. And we're going to be going over how to look for a key level, so where to trade from, what to look for, supply and demand buyers and sellers, and why a supply forms and why a demand forms. Now, with that being said, so the pre-market game plan is where essentially the money is, right? The money is in the pre-market game plan. So there's a phrase I love that's been reiterated in my mind over the years. It's understanding that if you fail to plan, you're planning to fail, right? So 9 to 9:30 Eastern is my pre-market game plan time. So during my pre-market game plan, I am looking at essentially overnight levels, and I'm looking to see how the market reacts at the overnight levels. So I'm looking for 15-minute fair value gaps as my key levels, just to be brief for now. And then I look to see how the market interacts at these levels. So what you can see here is we had a level that this is a true demand area in the market, and we're going to break down why. This was a true area of demand, and the trade from Thursday of last week is breaking down the same buy at the same demand area. So how did I know the markets were going to move up, right? So classic question that I get, right? So what I'm looking for pre-market, so I plan my markets from 9 to 9:30 Eastern every day. So what I look for previous day liquidity. I look for zones that have held and zones that have been broken and how they've been broken. So I'm looking to see. So for example, I'm not going to be trading this zone, right? Because we had, I think it was a CPI news or something like that, which broke through the entire level, 8:30 Eastern. So I'm not really looking at this zone. However, I am looking at this zone, right? And the reason why I want to be looking at that zone is because of this. Right, so CPI 8:30 Eastern. Right, look at what happened here. We had the Asian low, and which also coincided with the previous day low. Now, what's interesting about this is when you see a sweep of the previous day low and price struggles to break below the previous day low at a key level, I'm immediately thinking, okay, if we can reclaim this same area, buyers will be in control, and I want to be taking buys. And that's basically how the trade was formed, right? That's how the trade was formed. So between 9 and 9:30, I'm coming to my chart and I'm going, okay, this is the previous day high, which I've not marked, and this was the previous day low. That has been now swept. Now, when we take out the previous day low, price will often gravitate towards the previous day high. Those who have studied ICT concepts or just generally price action concepts would have seen how the market reacts around the previous day lows and the previous day highs. And so this was the game plan. So 14:05, so I'm in the UK, so 5 hours ahead. That's 9:05 Eastern, right? So we're in an interesting zone I've labeled here. If we can get the market to reclaim this area, which was a demand area from yesterday, we're looking for a break and a retest to go long. And so that's how the trade itself was formed, right? So order flow over execution. This is important to understand, right? Order flow will beat any type of execution. Now, the reason why is because order flow tells you the why, and we're going to be getting into the why in a lot of detail. So if I continue this on, this is the break and retest. So if I just go to the next slide, so this was essentially the trade, right? So what we can see here is we can see a very, very clean, if I kind of zoom in a little bit, we can see a clean break above the level and the retest. So a key level was formed. We're looking for price to enter the level, give us a break and retest. And that's how I form all of my trades. Every single one of my trades comes down to a very, very simple break and retest. That's how all the trades essentially form, right? So we're going to take this now. We're going to go over to the chart. So approaching the markets right now, this is the CPI news event. And so the CPI news event I spoke about earlier coincides with the market taking out the previous day low. So the previous day low looks something like this, right? So if we just kind of break this down, the previous day low, I always like to mark out the previous day low, which happens to be the Asian session low, which is another good confluence. So now from here, if we go down to the 5-minute chart, I'm going to be breaking down my trades from that day, right? So I'm going to be breaking down a loss I took, then the subsequent win that I took. So firstly, I want to make clear to traders that I never trade the first 5 minutes of the session, right? So from 9:30 to 9:35, I'm just observing. I want to see how the market reacts at key levels. So initially what I saw over here is I wanted to take a short from here. Now this is very foolish of me. So what I did is I saw price essentially breaking to the upside and I took a short over here and I had my stop loss just above here. And the reason I took that short was stupidly, I didn't wait for confirmation. And so my first piece of confirmation to every trader is you want to be trading only after the first 5 minutes. So do not trade the first 5 minutes. Don't try to catch the opening range break or whatever they call it. Let the markets develop. So what my plan for this trade was is, again, I was forcing a bias, right? So this is mistakes I still make, in 8, 9, 10 years later, where I saw a fair value gap down here. So what I was planning to do was I was planning to target this fair value gap, right? So I saw a nice risk to reward from that. Essentially what I had seen is I had seen price on the 1 minute totally incorrect to me. I didn't even consider the previous day low being swept. I saw aggressive buyers failing here on the order flow. I saw aggressive buyers failing here. So I decided to go short at probably 9:33 Eastern, which again, you can probably see I exited around here, and that resulted in a loss, right? So that was the loss I took in the session, right? So how could I have avoided that loss? So I've now set rules for myself, and I broke a rule, right? I had the rule and I broke the rule. I don't trade the first 5 minutes, right? I do not trade the first 5 minutes of a session, regardless of how good the setup may seem. I use the first 5 minutes as a way to gauge how price is behaving at key levels. So to give you some context about this particular trade, right, what happened on the previous day was we saw this as a strong area of demand, right? So again, this is now where, what, why. So where are we trading from? So we want to be trading from a 15-minute fair value gap. So we're looking for a key level, right? That's the first thing we're looking for. We're looking for a key level. So a key level is derived from a 15-minute fair value gap just over here. So this is a 15-minute fair value gap. I'm going to label that in gray. And this was also down here a 15-minute fair value gap as well. We can see the market did kind of fill this fair value gap over here. So this was the key level that I had. But most importantly, what you want to understand is that it's derived from a 15-minute fair value gap. Now, if you're a trader, again, who struggles with any kind of psychology, I want you to understand 1 minute price action only in and around 15-minute key levels, 15-minute fair value gaps. So we had a reversal from here, right? The reason that reversal happened is because we're understanding where to trade from, but more importantly, what to look for. So what was I looking for? I was looking for an area of demand. So what that means is I want to see buyers in control. I want to see passive buy limit orders resting in this area. And that leads on to the why, right? Why does the market move up in the first place? Or why did the market see a support here or see a demand? Because there were passive, I'm just going to spell that right, there were passive buyers. Now, I want every trader to understand that if you understood that the market moves up when there are passive buyers present and the market moves down when there's passive sellers present, you will be way more profitable, right? This is where the order flow comes in. This is why the order flow is so powerful. But just if we look at this 5 minutes into the market, what we can see here, if we just go down to the 1 minute chart, what you can see here is we had a imbalance that was left, a fair value gap that was left all the way from that news event at 8:30 Eastern. Sorry, so I'll give you a thumbs up about these news events. Something I've done. Sorry. And you can backtest this, in your own time as well. When you have price giving a huge fair value gap, or when price reclaims a fair value gap at key level, after the news events, price will often refill the entire fair value gap. That's something I've noticed from many years of trading, right? You may have noticed it too, right? It happens, CPI, NFP, this fair value gap here is our target, right? This is our final TP, if you like, right? Another question I get, how can I stop being greedy? That's another common problem I get, right? How can you stop being greedy? The simple way to stop being greedy as a trader is to do this, right? Identify your fair value gaps, and then from there, derive your point of interest, derive your POI. So my 15-minute POI is just the candle before the fair value gap, right? This is the key level. Now, we had such a strong a strong move down from here, CPI, right? So yes, we took out the previous day low. We failed to close below the previous day low. Now from here, realistically, I will not try and hold my trade all the way to the moon, right? I'm not going to do that. I'm going to trade from one key level to the next. And so this is the simplicity of trading. I often say trading is simple, not easy. We want to move towards trading being simple and easy. And how do you make it simple? Well, you make it simple by eliminating the number of steps that you use. So with me, it's a 3-step process. And I always talk about the 3-step process being you need a key level, you need an entry into the key level, and then you need to know order flow. And so order flow will tell you whether buyers and sellers are in control, right? So you want to make trading simple and easy. So by making it simple, you're only relying on 3 steps. But to make it easy, it only comes with one thing, and that's practice. It's practice and the ability to sit down and understand what's happening. And we're going to dissect this in a lot of detail. Also, another thing, it's also important to dissect your losses. So for example, my sell at 14.33 was basically a FOMO position, right? So I thought price was going to go all the way down to the fair value gap over here, right? So I'm trading from one fair value gap to the next. Now, this loss could have been avoided if I simply followed my rules. And so I have a rule where I don't trade the first 5 minutes. Today I broke the rule. I traded at 9.33. I should have waited. Now, if I had waited, I could have avoided that loss, right? So the trade itself that I took, if I just load up the screen over here, the Discord. So the trade I took itself was this position here. So targeting essentially this fair value gap up here, right? So that was the position itself. We had a pretty steep retest before we hit there in the end, and I actually exited at probably 2R, right? So I kind of put my stop below here, exited here when I saw price reacting off this 1 minute fair value gap. So that was about $465 for the day, around 2.2R, which was, I'm more than happy with that. I think that wasn't a bad trade. But if we just kind of break that down in terms of, we're gonna be focusing now on this, right? So first I had this first trade, 465. Then I had this second trade, which was just under $200, right? So we're going to be breaking down this key level. So this key level and this kind of key level up here. But breaking down this first trade, we're going to understand this chart, right? So this chart is my favorite chart, right? This is my favorite chart. I speak about this on every video. So let's kind of break down why the market moved higher. So give me a second to push this over here. Let's see exactly what was going on. So basically, what you're looking for is this is the sequence I'm looking for. When you want to see an area of demand is formed when aggressive, I'm just going to write AGG, when aggressive sellers fail. And so that means that there's buy limit orders in control, right? Buy limit orders, you can call these passive buyers as well. So that's what you're looking for. And you're looking for it in this region there, right? So when you see this retest forming the way it does, this is what you're looking for. So if I kind of bring up the screen again, here's where we have your initial entry, right? So I want traders to just focus on, I'm not going to speak about any of the numbers. I'm only going to speak about the delta. You only need to read a few numbers. So why does the market move up? Triple X, where, what, why. The final step to understand here is the why. And so this can save you a lot of losses as well if you simply knew which break and retest was going to work. So can you see here, there's a ton of red delta. You can see red, red, red. There's a lot of red sitting over here, a lot of red here. And this candle here is the most interesting. We saw essentially the entry, so we saw a break and a retest. So you want to enter upon a successful retest. So this was your successful retest. What was happening over here? So I'm just going to enlarge in this as well so we can really focus on this price action, because this is what I want every trader to understand. So when you see price coming into a key level, this blue box, right, you're seeing here 66 for 0 and you're seeing 140 for 60, right, the bottom of this candle before you see the market breaking to the upside. So it shows you here the aggressive sellers have failed to reclaim the level. It shows you aggressive sellers have failed at this key level, at this fair value gap. So what does that tell you about the price action here? Should you be buying or selling? If all the aggressive sellers fail, what does that tell you about the buyers, right? Even here as well, you saw this wick over here. This wick here, what's super interesting is this wick here, 249 for 64, 29 for 0. Now there's two things you want to understand from here. Firstly, you see red delta right at the POI, right at the key level, right? That means that there's a ton of aggressive sellers and none of them get rewarded. Because if they were rewarded, you wouldn't have had this massive, great big whopping candle where my second entry was just over here. The reason why the markets move up is because the aggressive sellers failed. Now what's interesting here is you see 29 for 0. So the 29 for 0 means that the auction has been wiped out. So when you see a 0 on one side, when you see a low and a high in the movement, that's telling you that the sellers, that there's no aggressive buyers, that there's only aggressive sellers. So it shows you here, there's passive buyers that are absorbing these sell market orders, and that's what drove price higher. So that there was essentially the long position that I took, roughly from this area, so stop loss below the zone, and you're just looking to target the next zone over here, right? So this was roughly whatever it was, a 2.2R trade, whatever it was, right? So now one last thing I want to finish on. So even though the markets was kind of choppy, what you want to focus on here is this deep retracement, which I did panic a little bit when I saw this. I was willing to stop out roughly here at roughly minus 0.7 R. But again, why did I not stop out? So when I saw a lot of aggressive sellers coming in and I saw price breaking higher, that confirms this as a demand area, and we just target the next fair value gap, right? So I want traders to walk away with this knowledge, and I'm going to finish the video just with this picture over here.